There's this guy who walks into a casino every Saturday night for 10 years. Same casino, same blackjack table. He follows basic strategy perfectly, never deviates, and over a decade, he's up about 17% total. Not bad. But there's another table in the back room, past the velvet rope, where a different game is running. Same cards, same rules, but they're betting on which dealer is hottest that night. And over those same 10 years, they're up 43%. The first guy has no idea the back room even exists. That's basically what's happening in index fund investing right now. And I spent 3 years reading SEC filings to figure out why nobody talks about it. Here's what we're doing today. I'm going to explain how momentum factor investing actually works, why the fund industry has zero incentive to tell you about it, and specifically why one ETF has been smoking VOO by enough that it could cut 5 years off your retirement timeline. And I'm going to show you the exact allocation strategy that makes sense for someone who isn't trying to become a day trader, just trying to not leave 6 figures on the table over a 20-year horizon. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Okay. So let me start with the simplest model. Think of the stock market like a nightclub. VOO, the Vanguard S&P 500 ETF, is the main floor. 500 companies, all sizes, all dancing. You buy VOO, you own a piece of everyone. Low cost, diversified, perfectly sensible. This is what every financial advisor tells you to do because honestly, it works. 10% annualized over the long run, you'll retire fine. But there's a VIP section most people don't know exists. And the bouncer at that velvet rope isn't checking how much money you have or who you know. He's checking one thing, momentum. Which stocks are actually moving right now? Not which companies have the best story or the most inspiring CEO. Which stocks have the strongest price momentum over the last 6 to 12 months? That's it. That's the filter. The ETF that runs this strategy is SPMO, Invesco S&P 500 Momentum ETF. And here's what nobody tells you. Over the last 5 years, SPMO has annualized around 21 to 22%. VOO, 17 to 18. That gap, that extra 3 to 4 percentage points per year, compounds into a completely different retirement outcome. Let me give you real numbers. If you invest $200,000 today and get 17% annualized for 20 years, you end up with about $4.7 million. Same, $200,000 at 21%, you end up with $7.8 million. That's $3 million of difference. That's not a rounding error. That's your kid's college paid for and a house in cash. Now you're asking yourself, if this is so obvious, why isn't everyone doing it? Great question. And this is where it gets really interesting. Because the answer isn't about the fund, it's about the incentives. Here's escalation 1. The financial services industry makes money in 2 ways: management fees and assets under management. VOO has $600 billion in assets. It charges 3 basis points. That's 0.03% per year. SPMO has about $8 billion in assets and charges 13 basis points. You see the problem? Vanguard makes way more total dollars off VOO even though the fee is lower because the asset base is 75 times bigger. So when a financial advisor is deciding what to recommend, they're not thinking about your optimal returns. They're thinking about liability. If they recommend VOO and you underperform, nobody can sue them. That's the standard advice. But if they recommend SPMO and you underperform for 2 years during a sideways market, suddenly they're getting phone calls. Why did you put me in this weird fund I've never heard of? The incentive structure is designed to keep you in the main nightclub, not because it's bad, but because it's safe for them. Here's escalation 2. Momentum investing has been academically studied since the 90s. Eugene Fama and Kenneth French, the guys who basically invented modern portfolio theory, published research showing momentum is a real, persistent factor. Stocks that are going up tend to keep going up for 6 to 12 months. It's not magic. It's behavioral finance. When a stock starts performing well, institutional money piles in, which pushes the price higher, which attracts more attention, which brings in more capital. It's a feedback loop. But here's the thing that blew my mind when I read the research. The momentum premium, meaning the excess return you get from momentum strategies, has existed for over a century. This isn't some new algorithm. This isn't high-frequency trading. This is just riding the wave of what's already working. And yet, if you go to any mainstream financial website, Motley Fool, Investopedia, CNBC, you will see 10 articles about VOO for every one article about SPMO. Why? Because momentum strategies are harder to explain to a mass audience. They sound like market timing, they sound risky. And most importantly, they require someone to admit that buy and hold isn't the only way. Here's escalation 3. Let's talk about what you're actually buying when you buy SPMO. The fund looks at all 500 S&P companies and ranks them by price momentum. Then it takes the top 100 and allocates more weight to the strongest performers. Right now, as of early 2026, the top 10 holdings make up about 54% of the fund. Compare that to VOO, where the top 10 make up 39%. So SPMO is more concentrated. That means higher volatility. When the market rips, SPMO rips harder. When the market dumps, SPMO dumps harder. In 2022, when tech stocks got hammered, SPMO didn't have the same cushion that VOO did. It fell further. That's the trade-off. But here's what most people miss. Higher volatility doesn't mean higher risk if your time horizon is long enough. Let me say that again. If you're investing for 20 years, short-term volatility is just noise. What matters is the compound annual growth rate. And SPMO's CAGR has been higher. The problem is human psychology. Most people can't stomach watching their portfolio drop 25% in a year, even if they know it's going to recover. They panic. They sell at the bottom. They lock in losses. And that's why momentum strategies don't work for everyone. Not because the math is bad, but because people are bad at math when they're emotional. Here's escalation 4, and this is the kicker. SPMO rebalances twice a year. Every May and November, it kicks out the stocks that are losing momentum and brings in the new winners. This is not a passive strategy in the traditional sense. It's rules-based and systematic, but it's active in terms of turnover. And here's where the tax conversation comes in. Higher turnover usually means more realized capital gains, which means more taxes if you're holding this in a taxable brokerage account. But, and this is critical, ETFs are way more tax efficient than mutual funds because of how they're structured. They can do in-kind redemptions, which means they don't have to sell stocks to meet redemptions, which means they don't pass capital gains on to you. So while SPMO does have higher turnover than VOO, it's not a tax nightmare. But if you're really worried about taxes, just hold it in a Roth IRA or a 401k. Problem solved. In a tax-advantaged account, turnover is completely irrelevant because you're not paying taxes on gains until you withdraw, or in the case of a Roth, never. Now, let me give you a mini case study with real numbers, so this feels concrete. Let's say you're 35 years old. You've got $50,000 saved up. You want to retire at 55 with $2 million. That's a 20-year timeline. If you put all $50,000 into VOO and contribute $500 a month, assuming 17% annualized returns, you'll end up with about 1.9 million. You're close, but you don't quite hit your goal. You need to increase your monthly contribution to 550 to get there. Now, same scenario, but you allocate 80% VOO and 20% SPMO. Your blended return goes up to about 18.2%. With that allocation and the same $500 monthly contribution, you end up with 2.1 million. You hit your goal and you have a buffer. That 20% allocation to SPMO added $200,000 to your outcome. That's the difference between retiring at 55 and retiring at 53. That's real. But here are the two comedic cutaways, because this is getting heavy. First cutaway. I can already hear the Reddit comments. But Tom, what about the expense ratio? SPMO charges 13 basis points and VOO charges 3. That's 0.1% more per year. Over 20 years, that's like, carry the one, I don't know, a lot of money probably? Okay, sure, let's do the math. On a $100,000 portfolio, 0.1% is $100 per year. If SPMO outperforms by even 1% annually, that's $1,000 of extra gain. The expense ratio is noise. You're optimizing for the wrong variable. Second cutaway. My accountant, lovely guy, total pessimist, once told me, Tom, you know what the problem with momentum investing is? Eventually, you're just buying the top. And I said, yeah. And eventually, VOO is just buying 500 companies, including the ones about to go bankrupt. What's your point? He didn't have a good answer. The point is, every strategy has flaws. The question is whether the edge outweighs the cost. All right, now let me address the elephant in the room. SPMO's top holdings right now are companies like Broadcom, Nvidia, Meta, JP Morgan. It's heavy on tech and financials. If those sectors get hit, SPMO feels it more than a diversified fund. That happened in late 2022. Tech got destroyed and SPMO underperformed. So is momentum investing just lucky because tech has been ripping for the last few years? No. And here's why. Momentum strategies don't care about sector. They care about price action. If energy stocks start ripping and tech stalls, SPMO will rotate into energy. The fund rebalances twice a year specifically to avoid getting stuck in yesterday's winners. That said, momentum strategies do have periods of underperformance. Specifically, they struggle in choppy, sideways markets where nothing is really trending. If we enter a multi-year period of low volatility and low directional movement, SPMO could lag VOO. That's a real risk. But here's my counterargument. If you're waiting for the perfect fund with zero downside, you're going to wait forever. VOO underperformed during the 2000s. It got crushed in 2008. Every fund has bad years. The question is whether the long-term data supports the strategy. And for momentum, it does. Now, before I give you the practical takeaways, let me tell you what I actually do with my own money. Because I've got multiple hundreds of thousands of dollars invested, and I need you to understand I'm not just theory here. I run my own business. I've been doing this for 10 years, and I'm surrounded by accountants and fiscal lawyers who taught me how money actually moves. So here's my allocation. I keep 70% in VOO. That's my foundation. That's stability. That's the part of my portfolio I never touch. Then I've got 15% in SPMO. That's my momentum exposure. It gooses my returns without making me nervous when the market dips. The remaining 15% is split between international exposure and a small allocation to treasury bonds for when I want to rebalance during a crash. I rebalance once a year in January. That's it. I don't check my portfolio daily. I don't try to time the market. I just let the math do its thing. And over the last 5 years, my blended return has been north of 19% annualized. That's not because I'm smart. It's because I read the boring documents and structured my portfolio based on data, not feelings. And here's the thing. Lazy investing built more fortune than crypto memes. The people who got rich off index funds didn't do it by finding the secret ticker symbol. They did it by starting early, staying consistent, and not panicking when CNBC told them the sky was falling. All right, here are your 3 practical takeaways. And I'm going to make these hyper-specific because generic advice is useless. Takeaway 1. If you're going to add SPMO to your portfolio, start with a small allocation, 5 to 15% max. Do not, I repeat, do not sell all your VOO and go all in on SPMO. That's how you end up panic selling during the next correction. You want enough exposure to capture the upside, but not so much that you lose sleep when it drops 20% in 3 months. Takeaway 2, hold SPMO in a tax-advantaged account if possible. Roth IRA, traditional IRA, 401k, whatever. The higher turnover means more potential tax drag in a taxable account. If you're holding it in a brokerage account, that's fine. Just be aware you might owe more in taxes. Run the numbers with your accountant or use tax loss harvesting to offset gains. Takeaway 3, automate your contributions and ignore the noise. Set up automatic monthly investments and then don't look at your portfolio for 6 months. The biggest mistake people make with momentum strategies is checking their account every day and freaking out during periods of underperformance. If you can't handle volatility, this isn't for you. Stick with VOO. There's no shame in that. But if you can stomach the swings, SPMO gives you a real edge. So there it is, the hidden ETF that's been quietly beating VOO while everyone else is still arguing about stock picking versus index funds. SPMO isn't perfect. It's more volatile, it's more concentrated, and it's not going to outperform every single year. But over the long run, the data shows it delivers higher returns. And in a world where an extra 3% per year can mean retiring 5 years earlier, that matters. The system doesn't want you to know this stuff because the system makes money when you stay confused and stick with the default option. But you're here, you read this far, and now you know. What you do with that information is up to you. Just remember, the difference between people who build wealth and people who stay stuck isn't intelligence. It's information and action. You've got the information now, so go take the action.